Welcome back to the Deep Dive. Today, we are undertaking a substantial exploration into the world of cryptocurrency in 2025. You shared sources with us that provide an incredibly detailed year-end retrospective centered on one project, the Pi Network. And this isn't just about a single coin. It's a profound case study in the modern crypto landscape.
It truly is. I mean, when we step back and analyze the data for Pi Network in 2025, the sources repeatedly label it a watershed year.
Yeah.
But the story is just dominated by these radical internal contradictions.
Contradictions? How so?
Well, we're looking at a project that achieved fundamental success, massive technical milestones, near exponential user growth. But then you see that success seems completely divorced from its speculative market pricing.
Oh, okay.
It's a textbook example of, adoption at a massive scale meeting market inertia and some really serious structural constraints.
Adoption meeting market inertia. That framing, that really gets to the core of the paradox we have to unpack here. We have to address the central conflict immediately because it's so stark, it's almost unbelievable.
It is.
Our compiled material shows that Pi's price fell by a staggering 53% over the course of 2025. And this happened even as their user base, which they call pioneers, saw truly massive global growth. Something like 30 to 50% year over year. How can you have 70 million users and lose over half your market value?
That is the $1.8 billion question, right? Based on the market cap figures we have. So our mission today is to move beyond those surface level numbers.
Right.
We need to dissect why this disconnect happened and what it tells us about the maturation of the entire crypto space. We'll be analyzing Pi's technical readiness, of course, but we have to position its performance against the volatility of giants like Bitcoin and Ethereum.
And the regulatory side of things.
And critically, we have to factor in the regulatory hammer that dropped globally. I'm talking specifically about the transformative effect of the EU's MiCA regulation, which, completely redefined compliance in 2025.
So we're analyzing Pi not as an isolated project, but as a lens through which we can view the structural weaknesses and regulatory pressures facing any massive global crypto venture today.
Exactly. It's a story of grassroots enthusiasm running headlong into the cold, hard realities of liquidity, centralized exchange access, and regulatory compliance.
To understand the crash, we first have to understand the foundational success. Let's start with Pi Network fundamentals, because if you only look at the raw growth metrics, you'd assume 2025 was an unbridled triumph. So tell us, what is Pi Network and why did it gain such traction?
Sure. So Pi Network was launched in 2019 by a team of Stanford PhDs, and its core innovation was this mobile-first approach. They recognized that the biggest barrier to crypto adoption was, it was the energy consumption and the technical complexity of traditional mining.
You mean like Bitcoin mining?
Exactly, dominated by projects like Bitcoin.
So what's the practical difference for the average user?
It's simplicity and accessibility. They designed a system for what they call mobile mining, which is extremely low barrier and environmentally friendly.
So no need for a huge computer setup.
Right. You don't need a warehouse full of ASICs or high-end graphics cards. All a user, a pioneer, as they call them, needs to do is open the app and tap a single button once every 24 hours.
Just once a day.
That's it. That simple action initiates the mining session and confirms their presence on the network. The reward mechanism is tied not just to that tap, but to network expansion. It incentivizes users to grow the ecosystem, which in turn increases their mining rate.
So the whole idea is about democratizing access.
Precisely. Reducing the barrier to entry to almost zero, making it accessible to anyone with a smartphone anywhere in the world.
That approach obviously worked, given the user numbers we're about to get into. But 2025 was supposed to be the payoff year, right? Thanks to these major technical milestones that proved the system was ready to move past the initial testing phase. Let's look at the first critical one, the long-awaited open mainnet launch on February 20, 2025.
That was the moment of truth. Moving from a closed testnet, which is, essentially a simulated environment, a technical sandbox where assets have no real-world value, to an open mainnet is the transition from experiment to live blockchain.
And they had been in that test phase for a long time.
For 3+ years, the system had been operating in this walled garden. The open mainnet meant pioneers could, hypothetically, begin to use, transact, and potentially list their assets on secondary markets. It's the essential step for true utility.
And what did that launch actually entail, technically speaking? Was it just a matter of flipping a switch?
Oh, far from it. The open mainnet means the network's firewall is dropped. It allows external nodes and third-party developers to interact freely with the blockchain.
Which requires a lot of back-end stability.
It requires rigorous stress testing, ensuring the consensus algorithm, which is based on the Stellar Consensus Protocol, can handle potentially tens of millions of active transactions simultaneously without breaking down. The fact they achieved this, maintaining stability across such a huge user base, is a significant technical achievement that shouldn't be overlooked.
But the team wasn't content to just launch the mainnet. By November 22, 2025, the sources confirmed they achieved a critical step in regulatory positioning: ISO 2022 compliance. Let's spend some time on this because for many listeners, this might sound like dense financial jargon, but its importance is massive. What is ISO 2022?
Okay, so ISO 2022 is the global standard for financial messaging. Think of it as a universal language for payment systems and financial institutions.
The universal language.
Yeah. Historically, global banks used kind of clunky proprietary systems like Swift messaging. ISO 2022 is designed to replace those old systems with a structured, rich data language that allows institutions, banks, central banks, payment processors to communicate seamlessly.
So if they comply with this standard, what signal does that send to the market?
It signals a readiness for deep integration with traditional finance, specifically with central bank digital currencies, or CBDCs.
Ah, okay. The government-backed digital currencies.
Exactly. By aligning with ISO 2022, Pi Network is essentially saying we are structurally compatible with global banking infrastructure and future regulatory requirements. It's a proactive, strategic move. It attempts to bypass the regulatory uncertainty that's plaguing Bitcoin and Ethereum by seeking alignment. It ensures that if banks decide to use this standard for CBDCs, Pi can plug right in.
And the development didn't slow down, even as the price was plummeting. Towards the end of the year, in Q4 2025, they are already testing the next evolution, the Protocol 23 upgrade.
Yes, Protocol 23 focused squarely on building utility, specifically testing core functionality for decentralized exchanges, DXs, and automated market makers, AMMs.
So the infrastructure needed for trading within their own ecosystem.
This is the infrastructure needed to allow pioneers to trade and exchange Pi for other assets without relying solely on centralized entities. They reported having over 100 decentralized applications or day apps ready to deploy to the mainnet once this functionality was ready.
So on the technical checklist, open mainnet, CBDC alignment via ISO 2022, and utility infrastructure Pi Network was hitting all its long-term goals throughout 2025. And this success is directly mirrored in the user numbers.
Absolutely. This is where the exponential growth comes in. Look at these figures from the sources. In January 2025, they reported a monumental 47 million users.
47 million, that's already huge.
It is. But by the close of December 2025, that number had surged. It reached an estimated 60 to 70 million users, officially reported as over 60 million.
Wow, a 30 to 50% growth rate in a single year, starting from an already massive base. That solidifies Pi Network as a true global phenomenon in terms of grassroots adoption.
It's a scale few other non-social media platforms can claim, let alone a crypto project. The adoption rate is just undeniable.
But this brings us right back to the great contradiction. We have technical superiority, we have a regulatory strategy, we have a user base approaching the size of several major countries. Now let's introduce the price reality check. If the fundamentals were so strong, why did the price of Pi, which started January 2025 at around $0.43, giving it a market cap of about $3.5 billion fueled by high expectations, why did it close December 2025 at 0.2029 with a crash in market cap down to $1.70 billion?
That overall year-over-year drop of 53% is the paradox we face. It tells us that in the crypto market, unlike traditional business raw adoption, numbers and technical readiness are necessary, but they're not sufficient conditions for realizing value. The enthusiasm of 70 million pioneers was simply not translated into market liquidity or speculative pricing. And we need to dedicate the next segment to figuring out why that conversion failed so spectacularly.
That 53% collapse demands a deep explanation. Let's move into segment 2 and address the structural flaws, the internal bottlenecks and the external liquidity challenges. This is where that 70 million user base starts to look like a vanity metric rather than an indicator of market cap. You call this the fragmentation problem.
This is the crux of the issue. In traditional finance, every user is a potential transactor. In a decentralized ecosystem, especially one transitioning from a test phase, users must pass multiple gates. And Pi Network failed that conversion test in 2025 due to two massive operational bottlenecks: the Know Your Customer, or KYC process, and the Mainnet migration process.
Let's start with KYC, because that process is foundational to any compliant project. Walk us through the numbers on that bottleneck.
The sources reveal a staggering operational backlog. By December 2025, the project had only managed to KYC verify a little over 22 million users. Now, that sounds like a large number, but you have to consider the total user base of 60 to 70 million.
So only about a third of their users were actually verified.
Right. It means only about 33 to 37% of their pioneers had confirmed they were real, unique individuals, compliant with global anti-money laundering standards.
And why did that verification process stall so severely? I mean, it's been running for years.
The source material suggests a few hurdles. Firstly, Pi Network's KYC process relies heavily on a decentralized, community-driven validation system rather than purely centralized algorithms. And while this is, ideologically sound,
It creates slowdowns.
massive slowdowns. Community validators need time and training, and the sheer volume of 60 million global users speaking hundreds of languages creates a technical backlog and an anti-fraud complexity nightmare. They were simply unable to process the users fast enough to keep up with the new acquisition rate.
So you have two-thirds of your user base, maybe 40 to 50 million people, stuck behind a digital wall, unable to prove their identity. But even those 22 million who were KYC verified still weren't able to fully participate. Which brings us to the second bottleneck: Mainnet migration.
Exactly. Migration is the step that actually unlocks the value. After KYC verification, the user has to migrate their accumulated locked-up Pi tokens from the test environment to their live activated Mainnet wallet.
This is the moment they can actually use their coins.
This is the moment they can transact, use dApps, and theoretically provide liquidity to exchanges. But the sources indicate that only 15.7 million users had successfully migrated by the end of 2025.
15.7 million. Out of 60 million total, that's a mere 26% penetration.
That's correct. And this represents the ultimate operational failure of 2025. The inability to activate the literal point of transaction, the wallet, means the vast majority of the network's potential liquidity is just locked up.
So all those dApps and the promise of peer-to-peer commerce.
They're all severely limited because only 1/4 of the intended participants can actually move their coins.
It's a perfect analogy. 70 million people are in the stadium, they're confirmed ticket holders, but 74% of them are stuck between the outer gate and the inner seating bowl. They have no access to the actual game, which is why the market is making no money. And this operational failure, coupled with external pressures, contributed to the 53% price crash. Let's talk about that starvation bankruptcy reality the source mentions.
That phrase is brutal, but it's accurate. It describes a project starving for liquid capital despite having massive adoption. One key factor was just the irrational exuberance that preceded the open mainnet. A lot of pioneers had unrealistic expectations, clinging to speculative pre-mainnet prices that have floated around, $3 or higher?
And when the limited supply actually hit the market.
The market brutally corrected. The liquidity constraints became undeniable, and that led to widespread disillusionment and panic selling.
And a major contributor to that disillusionment is the clear liquidity issue. Where can pioneers actually trade their Pi?
The availability is still highly fragmented. Pi is primarily limited to just 3 centralized exchanges: OKX, Bitget, and Gate.io. And while OKX is a major global player, these 3 exchanges simply do not provide the depth, volume, or global accessibility necessary for a coin aiming to serve 70 million people.
And the missing link, which the sources point to as maybe the single biggest external choke point, is the absence of a listing on Binance.
Binance is the global crypto behemoth. It commands the highest volume, the deepest liquidity pools, and the broadest global reach. For Pi Network, a Binance listing would immediately solve many of its liquidity and price discovery issues. The sources note that the lack of this listing is a massive structural impediment, especially given that the Binance community itself previously voted against a listing.
Which indicates a general market skepticism.
A huge skepticism about the token's underlying value or liquidity, despite its user count. Without Binance, Pi Network remains confined to secondary, less liquid markets. It just severely caps its price potential.
And even with that limited liquidity, the network faces an unrelenting internal threat: supply pressure from scheduled token unlocks.
This is the ticking time bomb of 2025 into 2026. Tokens are unlocked on a schedule, and the sources note that 8.7 million tokens were released just in December 2025. This alone provides continuous selling pressure. But the real concern, the factor that drove the bearish sentiment at the end of 2025, is the projected unlock in January 2026.
Let's detail that projected unlock. It's classified as a major red flag.
It's exponentially larger. The source material highlights that a massive 134 million PI tokens are scheduled to unlock in January 2026. I mean, do the math. That is more than a 15-fold increase in scheduled supply release compared to the previous month. Even if a tiny fraction of those tokens is sold immediately, it projects massive future selling pressure onto an already fragile, illiquid market.
So this analysis gives us a crucial lesson for anyone looking at crypto adoption. Raw user numbers don't equate to market valuation.
Not until those users are fully KYC'd, migrated, and liquid. The market is pragmatic. It sees 70 million registered pioneers, but only 15.7 million activated wallets. The market isn't valuing potential, it's valuing liquid tradable supply. Until the KYC and migration pipelines are unblocked, the price will remain depressed. Pi Network has successfully built a crowd, but they are still struggling to open the front doors.
Okay, let's step back and zoom out. Pi Network's 2025 paradox occurred not in a vacuum, but during a highly turbulent year for the entire crypto ecosystem. We need to position Pi's struggle within the broader context of Bitcoin, Ethereum, and that regulatory tidal wave coming out of the EU.
Right. Pi's 53% drop didn't happen in a stable environment. It occurred while the majors were also struggling. Let's start with Bitcoin. Bitcoin started January 2025 at what, $94,419. There was monumental optimism, and it hit an all-time high of over $110,000 in May, driven by strong institutional adoption and ETF inflows.
That suggests a booming bull market, but the closing numbers tell a completely different, darker story.
They do. Despite that strong Q1 and mid-year spike, the sources show a decisive bearish reversal in the second half of the year. Bitcoin closed December 30, 2025, at $87,883. That's a 14.2% decline year over year. The initial institutional frenzy just waned significantly.
And the dominance of Bitcoin remained a key feature of the year, right? This starved capital flow to everything else.
Precisely. The sources confirm that Bitcoin dominance, the percentage of the total crypto market cap held by BTC, remains stubbornly high, holding around 61% during the first quarter. This signifies a persistent Bitcoin season where investors are seeking the perceived safety of Bitcoin. When Bitcoin dominance is this high, it creates a gravitational pull, sucking liquidity away from smaller projects.
So if Bitcoin was volatile and ultimately bearish, Ethereum, the alleged king of altcoins, fared only marginally better.
Ethereum definitely lagged. It started January 2025 at $3,353, and by year-end, it closed at $2,934. That's a 12.5% decline. Despite continuous progress on Layer 2 solutions and its DeFi ecosystem, investors were clearly prioritizing Bitcoin.
So the promised altcoin season, the environment that allows projects like Pi to flourish through speculative capital inflow, it just never arrived.
It was a no-show. The sources describe Ethereum as drowning, not because of any inherent flaw, but because the CoinMarketCap altcoin season index remained consistently below 25, and that sub-25 reading is the definitive indicator of a Bitcoin season. When the second largest asset is losing 12.5%, it dramatically limits the capital available for a project like Pi.
So Pi's internal structural failures were magnified by an external market that was simply not conducive to altcoin growth. Now let's add the regulatory layer, which underwent a fundamental shift in 2025. The implementation of the European Union's markets in crypto assets regulation, or MiCA.
MiCA is a genuine game changer. It represents the most sweeping, comprehensive attempt globally to regulate the crypto sector. Full implementation concluded on December 30, 2024, meaning 2025 was the first full year where operators had to function under its new strictures.
What specifically changed overnight on January 1st, 2025?
The mandate for CASP licensing crypto asset service provider became mandatory for all entities operating within the EU. This means if you want to provide exchange services, custodial services, you must be licensed by a relevant national authority.
And this isn't just a suggestion, this is law with severe penalties.
The stakes are incredibly high. The sources confirm that for entities found operating illegally, penalties start at a minimum of $500,000. This level of regulatory clarity created an immediate compliance bottleneck for smaller projects. By the end of 2025, only about 90 companies across the EU had secured full CASP authorization.
This pressure environment makes Pi Network's ISO 2022 compliance in November 2025 look like a highly strategic, almost prescient move.
It's a genius long-term move, even if the price didn't react immediately. Pi's compliance with ISO 2022 positions it explicitly for integration with regulated entities, signaling to European regulators that they are building a blockchain that can speak the traditional financial language.
But the irony is that despite being technically MiCA ready, Pi still couldn't leverage it to gain liquidity within the EU. Why the ongoing difficulty?
Well, the technical readiness, the ISO 2022 alignment, that's the foundation. But without a major centralized exchange, listing like a Binance that is also fully MiCA compliant and willing to list Pi, that technical compliance doesn't matter for price discovery. The infrastructure is built for regulatory success, but the bridge to the global liquidity pool remains inaccessible.
We've established the crash, the structural failures, and the turbulent market environment. Now let's pivot to the positive counter-narrative. Pi Network's unique market segmentation. This is where that 70 million user base suddenly stops looking like an irrelevant vanity metric.
It is a profound geographic phenomenon. Despite the massive 53% global price drop, the sentiment on the ground in emerging markets remained incredibly bullish. Pi Network was, astonishingly, the most followed token in both Asia and Africa during February 2025, according to CoinMarketCap's own data.
What were the specific figures that demonstrated that dominance?
The sources show 37.7% of all Pi follows originated in Asia and 43% originated in Africa. That's over 80% of their enthusiastic, active follower base concentrated in just two major regions.
So let's challenge the earlier notion that 70 million users are irrelevant. If Western finance isn't pricing this in, why are Asian and African communities so intensely focused on Pi?
It goes back to the core mobile-first, low-barrier model. In many emerging markets, accessibility is paramount. Traditional banking penetration can be low, transaction costs can be prohibitive. A mobile mining system that allows a user to accumulate a digital asset for free offers a genuinely tangible path to financial inclusion.
And what are the actual utility use cases being fostered there?
The utility is peer-to-peer commerce. The sources suggest that Pi's primary utility in these markets is being fostered through community-driven marketplaces, P2P exchanges of goods and services using Pi. This shows that the network has massive social and economic relevance, where accessibility and peer-to-peer exchange are critical, even if the global price remains low.
That distinction is vital. It implies that Pi is already successful, just in an economic ecosystem that doesn't necessarily interact with the price discovery mechanism of Binance. Let's use the comparative matrix from the sources now to summarize the performance of Pi, Bitcoin, and Ethereum in 2025.
Okay, we can clearly see the two divergent stories here. Start with user base growth. Pi Network exploded, posting a 40% growth rate. Bitcoin and Ethereum, as mature assets, have NA for this metric.
But immediately look at the price performance. Pi is at a devastating minus 53% year over year. Bitcoin ended lower by 14.2%, and Ethereum by 12.5%. Pi's collapse is entirely disproportionate.
Moving to technological readiness, all three are strong, marked as mature. Pi specifically hid the open mainnet launch.
Now, regulatory alignment, this is a shocking reversal. Pi is marked as highly aligned due to its ISO 2022 compliance. Bitcoin and Ethereum are marked as still disputes. Pi proactively solved a problem the giants are still fighting.
Yet, look at the perception of that alignment in the marking sentiment column. Pi is HIGH, but crucially only in Asia and Africa. Bitcoin is medium globally, and Ethereum is low W globally.
And here's the fatal constraint that nullifies Pi's structural advantages: liquidity. Bitcoin and Ethereum are everywhere. Pi Network is marked limited.
And finally, the internal operational failure, wallet activation. Pi is only 26% activated. That's 15.7 million out of 60 million users. This internal metric is Pi's single biggest constraint.
So the Pi paradox is inescapable. They had superior user acquisition and superior proactive regulatory compliance, but they failed drastically in liquidity and price realization due to internal fragmentation, the KYC migration bottleneck, and external exclusion, the lack of critical exchange access.
Exactly. It's the difficulty of converting scale into liquid tradable value. 2025 proved they have the vision and the technical chops, but the structural execution, getting those users fully KYC'd and listed on Binance, remains the choke point.
That assessment of 2025 brings us to the future. If 2025 was a year of painful contrast, 2026 is universally positioned by the sources as the make-or-break year for the Pi Network. Let's look forward, because the tests ahead are critical and, in some cases, immediate.
We are looking at existential tests, the results of which will determine the long-term viability of the Pi token. We have four major critical moments identified for 2026.
Let's start with the immense immediate threat we flagged earlier. The 134 million PI token unlock scheduled for January 2026. This is categorized as the first critical moment.
It has to be critical. Given the limited liquidity we analyze and the fact that this unlock is a 15x higher supply release than the previous month, this will be the definitive stability test for the network. The source material projects that this is a liquidity shock waiting to happen. If the current markets can't absorb this influx, the price floor could collapse.
The second critical moment is external but equally defining. The question mark around the Binance listing.
This is the highest stakes gamble. The source materials include explicit speculation that a listing on Binance could lead to a massive 300% price spike. That influx would absorb the 134 million token unlock. Conversely, a definitive final no from Binance would confirm the market's skepticism, causing an immediate 50% drop.
And beyond those two critical events, the network has two highly important technical goals for the year.
These are classified as high GH importance. First, the launch of smart contracts on the mainnet in Q1 2026. This is the mechanism needed to implement the functionality for those 100-plus apps.
And the second high importance goal connects back to their regulatory foresight, CBDC integration tests.
Yes. Conducting these tests throughout 2026 is the practical step that leverages their ISO 2022 compliance. They need to show that their network can successfully integrate with banks and traditional financial systems.
Now let's look at the possible outcomes based on the source material's probability assessment. Start with the optimistic view, the bullish scenario, which is given a 30% probability.
The bullish scenario demands perfect execution. First, they must secure the Binance listing in Q1, driving the price to the $0.50 to $1 range. Second, the success of that listing must absorb the 134 million token unlock. Third, the successful launch of Mainnet smart contracts must follow immediately, activating the utility ecosystem.
That requires a substantial reversal of fortune. What about the base case, the middle-of-the-road scenario that the sources assign a 50% probability?
The base case is essentially a continuation of the 2025 paradox. In this scenario, the price remains sluggish, flowing between $0.20 and $0.40. Mainnet growth continues gradually. Crucially, Binance delays its decision, postponing the listing until 2027. It's a non-collapse, but also a non-breakout scenario.
And finally, the bearish scenario, given a 20% probability.
This is the financial disaster scenario. It's triggered by the two critical tests failing. First, the 134 million unlock causes a massive market drop, pushing the price down to a catastrophic $0.10. Second, Binance issues a definitive no, leading to widespread credibility damage. The sources also suggest that if the KYC compliance failure persists, pioneers will actively abandon the project. If we synthesize our findings, 2025 was truly a year of painful refinement for Pi Network. While the price fell by 53%, the project simultaneously validated the potential of its mobile-first concept, achieving massive user growth and crucial technical and regulatory milestones. It showcased that low-barrier crypto works for developing markets while exposing the immense difficulty of converting mass adoption into liquid, tradable value.
The fundamental lesson for you, the learner, is this. A peer-to-peer ecosystem with 70 million potential users is a success story for social engineering and product design. But that incredible potential is currently trapped. It's walled off behind severe internal friction, the KYC and migration bottlenecks, coupled with the external challenge of liquidity access.
The network is technically MiCA-ready and strategically CBDC-aligned, demonstrating a focus on long-term sustainability. However, the market value doesn't reflect that readiness because the actual tradable supply is so fragmented and the major gatekeepers of global capital remain closed off.
The source material makes it clear that 2026 is entirely focused on unlocking that trapped value. Without sufficient KYC penetration, meaning moving past that dismal 33% mark, and without securing a major exchange listing like Binance, the year will be a true test of viability. It will determine whether Pi Network matures into a global payment layer or remains a fascinating yet confined phenomenon.
This story of the Pi Network in 2025 acts as a powerful warning to the entire industry. Technical excellence and user acquisition are necessary, but they are insufficient conditions for success. Liquidity, activated wallets, and regulatory integration are the final, non-negotiable barriers.
So after diving deep into the technical failures and market exclusions, what stands out to you as the single biggest barrier they must overcome in 2026? Is the immediate danger the January token unlock stability test, or is it the long-term credibility that hinges entirely on securing that Binance listing? This deep dive shows you exactly where the real risk and the potential reward lies.